Hi, everyone. Happy New Year. Larry Berman here, back to you after my second back surgery in as many months. And hopefully there's no more to go. And we have a great year in front of us, except for market risk. And for the next number of months, we think there's still going to be a pretty significant mismatch between what some of the markets out there are pricing in terms of risk return, and of what is likely going to happen from an economic perspective. So let's take a dive into the chart room and see what's we learned this week. There are a lot of economic data out this week, but none more important than the employment situation in the US, to a lesser extent here in Canada, although very important for Canadians for sure. And there was a big number in Canada, which surprised a lot of people, but the focus was in the US. And the initial reading, a little bit higher than expected, but the good news there, if you call it good news, that people are getting paid less, but good news from the inflationary standpoint. And the market initially liked that. We saw futures rally. We saw futures start to sell off in the first half hour of the day, pretty much back to unchanged. And then at 10 o'clock, we got the Institute for Supply Management on the services side, and the expectation there was for more expansion in December. And of course, we've started to see contraction. And that's where the market started to rip. When combined with the update for factory orders and durable goods, which when put together, basically, confirms that the fourth quarter handoff to Q1 from the production standpoint was very, very weak. From the labor standpoint, still pretty strong. Now, the unemployment rate ticked down a couple points. Participation rate jumped, which is great. But when they call people at their house and ask them if they're working, 770 odd thousand people said they had new jobs. And so when you factor that in, the dislocation between the employment survey and the household survey started to reconcile right at year end, and we knew there was a data integrity issue between the two of them. Throw that all into the hopper, especially when you look at this part of it and see prices paid coming down a little bit, that market viewed, okay, the Fed doesn't have to be as aggressive. And that really got the markets going, after 10 o'clock, and really never looked back. And as we sit here very late in the day, we're trading near the highs of the day, with the NASDAQ up around 3%, the broad S&P up around 2.5%. But here's what happened that really makes no sense at all when we look at Fed Fund futures. So, yesterday was the orange close, and today is the green. And so based on that data, they're pricing the Fed to be less aggressive in terms of peak rates and easing more. So it's starting to price in a recession into the curve. But here's where it doesn't reconcile when we get to look at earnings expectations. So this is the S&P, as all will know, and there's the nice rally we're seeing today. Now that we've rolled over the quarter, on our forward 12-month based earnings, we're looking at for 2023 about $226 in earnings, and trailing earnings in the bag are 206. So we're expecting earnings growth in 2023 in a market environment that's almost certainly going to come with it a recession, because that's what the markets are telling us. They're pricing it in. This is not bullish for equities. So the algos, or the program trading going on here, buying in relationship to these new data points we got today on employment and on the ISM services, to me, are thinking about what used to happen when the economy slows, the Fed will ease. They are not going to ease. Higher for longer is the message. They want to squash inflation. rallies here need to be faded. That's the big message this week. And we don't have a bull and bear pick for you because, what do I comfortably tell people to go out and buy right now? Months ago, precious metals look great. They're ripping now, and maybe there's a little momentum there left to go. But the reality is most assets are going to have an earnings impact hit in the next few quarters, 2, 3, 4. The real damage to the economy doesn't happen until the labor market stops firing in all cylinders. And the Fed is not going to stop raising rates until they start to see that happening. It's just a crazy combination that no one investing today has ever seen. No algo is programmed. And I think you have a lot of fast money making dumb decisions today. So that's kind of my spin on the markets this week. Anyways, looking forward to an exciting and volatile 2023 that should present a lot of great buying opportunities, later this year. But right now, unless you're a short-term trader willing to trade for a couple hours and maybe a few days, you don't want to chase a rally here. Now, if we take out this previous high that we saw in early December and mid-December, I'm probably wrong, and the market's back into a bullish mode, having made a higher high and a higher low. I doubt that very much happens, but it is a scenario that if it happens, we really need to rethink our strategy here in 2023. But for now, call it a trading range between the lows we saw in September and October, the highs we made in November, December, and everything in between there is a lot of trading noise and opportunity. Have a great year, everyone.